VOO versus SCHD, the ETF cage match. Do you want to get rich or get paid? If I'm thinking like a long-term wealth builder in a red suit, VOO versus SCHD isn't really a question of which one is better. It's a question of what job I want my money to do. Do I want maximum broad market growth with super low fees and a tiny yield, VOO? Or do I want a portfolio that throws off real cash every quarter with higher yield and a value tilt, SCHD? VOO is the pure engine of American capitalism in ETF form. It tracks the S&P 500, giving me exposure to about 500 of the largest U.S. companies, covering roughly 80% of the total U.S. stock market by value. It uses a simple market cap weighting methodology, which means the bigger the company, the more of it I own. And today that means I'm heavily exposed to mega cap tech and growth names that have driven most of the market's returns. Vanguard runs VOO with an expense ratio of just 0.03%, meaning I'm paying $3 a year for every $10,000 invested. Basically free, especially for an ETF that's become one of the core building blocks of long-term portfolios worldwide. The trade-off is that VOO is not an income monster. Its 30-day SEC yield is around 1.1 to 1.2%, with a trailing dividend yield in that same low single-digit range, because the S&P 500 is filled with growth companies that reinvest profits instead of paying them all out. On top of that, recent research points out that the S&P 500 is now very concentrated, with over 40% of its weight in just 10 stocks, mostly in tech and communication services, and it trades at a forward PE that's more than 20% above its 10-year average. So when I buy VOO, I'm admitting that I'm okay with owning a concentrated, growth-heavy, slightly expensive U.S. large-cap market, because I believe that over 10 to 20 years, those companies will keep growing, innovating, and compounding my wealth. SCHD, on the other hand, is like VOO's older cash flow obsessed cousin. Instead of trying to own the entire S&P 500, SCHD tracks the Dow Jones US Dividend 100 Index, a rules-based basket of about 100 U.S. stocks selected for high dividend yield plus quality and sustainability. Companies that have a robust history of paying dividends, strong free cash flow, solid return on equity, and relatively conservative payout ratios. ETF.com. The payoff for playing in SCHD's world is income. As of late 2025, SCHD's SEC yield is around 3.8 to 3.9%, and its trailing 12-month distribution yield is also just under 4%, more than 3 times the yield of VOO, and one of the highest among large diversified dividend ETFs. That means if I'm trying to create a portfolio that literally pays my bills, SCHD starts looking like a cash flow machine. $100,000 in SCHD might throw off close to $3,800 to $4,000 a year in dividends at current yields, versus barely over $1,000 to $1,200 from VOO. At the same time, SCHD isn't just chasing yield blindly. It screens for quality, has a 5-year dividend growth rate around 10%, and focuses on big established names with a weighted average market cap around $135 billion, a forward PE of about 16.7, and strong return on equity around 29%, giving me exposure to profitable, shareholder-friendly businesses that historically have held up relatively well in rough markets. Sector-wise, SCHD looks different from VOO. Its index tends to be heavy in energy, consumer defensive, industrials, and healthcare, and intentionally excludes REITs and MLPs, which keeps its holdings in traditional corporations, but also means its sector bet is more value, cash flow oriented, and less about pure high-growth tech dominance. So if I imagine 2 versions of myself, Builder me and Cash Flow me, VOO is what Builder me uses when I'm still in my accumulation phase. I'm working, I don't need my portfolio to pay my bills, and I just want to shovel as much money as possible into a low-cost, broad market fund that lets the U.S. economy do the heavy lifting over decades. Historically, the S&P 500 has delivered strong long-term total returns, and VOO tracks it almost perfectly with minimal tracking error and negligible turnover, So it's like a set it and forget it engine for long-term compounding. I don't have to guess sectors. I don't have to pick stocks. I don't even have to think. Cash flow me, on the other hand, cares less about squeezing out every last bit of capital gains and more about consistent growing income. That's where SCHD shines. Not only does SCHD currently yield about 3 to 4%, but it has built a reputation as a dividend growth ETF with double-digit 5-year dividend growth and a clean, rules-based process that has earned it top billing in lists of the best dividend ETFs to buy now in 2025. And remember, this is education, not financial advice. Follow at the Red Suit Investor.